So hope everybody are going through this Moodle page of LMS, Financial Management. So I have been putting all the PPTs and what all the materials that has been required for your pre-read, post-read, everything it has been posted here. And so far what we have discussed until 5th session, it has been there, PPTs. So today is 6th and 7th session, right? So post this session, I'll be putting, if at all I'm using any PPTs, it will come up here. Okay. So the most important aspect is you must have gone through this YouTube videos as well. So this is session wise, it has been put up here. So I'm assuming that everybody of you are going through these YouTube videos before attending my sessions. Hope my assumption is true. I don't know. Okay. So today's case is a risk and return. So how many of you gone through this case? Just a 2-page case of Harvard given to you, in fact. So this is our first 6th session. We'll be discussing about risk and return. Supposing if you could complete this discussion in 30-40 minutes, then we'll move on to the next session, that is DCF valuation, because that is where the majority of our most of our time is actually going to be getting utilized there, because a discussion of DCF valuation is slightly elaborative. Fine. So hope you must have downloaded this template as well. This folder as well as this template, you should actually keep this, both of this ready for the today's session. And somebody raised a question when we were actually I was handling on offline session. Okay, so I also put up that doubt raised in the session 3. You can see this. Someone asked me like how to compute PMT. Supposing if my 5% my investment is going up by 5% every month, every year. Somebody asked me that in the class. So I also answered this query. You can just go through this Excel sheet. So doubt has been cleared here. So we have used a goal seek function to solve the problem. Okay, you can go through this. Those who have asked me this. Okay. And everything else here is self-explanatory. Just a minute. Okay, so we shall start now for this session 6. Hope this PDF is visible.
Yes, sir.
Okay, so Beta Management Company is a company which is there in US, and let us say Miss Wolf was the founder and CEO of Beta Management Group, a small investment management company based in Boston suburb. So this is a small company. They were actually managing the various investments of their clients. It's a small company as per this particular case. You must have seen this. She considered herself as a market strategist, and Beta Management stated goals were to enhance returns but reduce the risk for the clients via market timing. Okay, so she wants to increase the returns for her clients. At the same time, she wants to keep the risk as low as possible. That is what is her strategy. And she wants to time the market. What do you mean by timing the market? Anybody would like to throw some light on this?
The duration for which market is open.
No, that is called as market
Stock
timing.
market.
What do you mean by market timing?
The right time to not invest in the market if the market is declining.
Sir, buying at low, trying to buying at low and selling at high.
Correct. So that is right, actually. So what you do is you just buy it, and what is your intention is if you feel that the market is going down, you sell it. If the market is going down as per your expectation, you go and again buy it at the lower lows, and you want to sell at a higher highs, given a chance. And if you keep on doing it, then that is actually called as timing the market. Is it clear, everybody, what is timing the market? Which means you expect that the market is going to fall in the near future, so you sell off right now. And once the market goes down, you enter at that particular price point. And then you would like to make an extraordinary return by timing the market. Hope it is clear. But it is difficult to time the market. Normally, the long-term investors like Warren Buffett and everybody says that timing the market should not be done because you don't know when the market is actually going to be going up and going down. You should not be playing around with it. Normally, you should actually stay invested in the long term. That is what they say, actually. Okay, so timing the market, 99% of the cases, it will not happen. Even if you have tried it many a times, you must have been unsuccessful. If you are successful, it is only by chance. Okay, that is all about the market timing. It is. Okay, so given the small size of her account, the easiest way for her to maintain and adjust equity market exposure was to index. What she was doing is she was actually playing around with the index. Index was her major investment, what she was doing. Can we buy index? The first question is, can we buy index?
Yes.
Yes. Yes. Absolutely.
Okay, so the answer is we can't really buy the index because it's just a competition. It is. Okay, there are various products are available, maybe which are going to mimic exactly like an index, maybe mutual fund or maybe any ETF for that matter. You can buy them. If you know what is derivatives market, then there also you can go and buy the futures and options, and that's how you will be having exposure to index. So it is literally impossible to buy an index in a literal sense. What I'm trying to say is, however, there are some products which are actually going to be mimicking the returns of the index. That is how we are actually going to be buying and selling. Hope my understanding is correct. Hope you're understanding what I'm trying to say.
Understood, sir.
Yeah. So next is she would keep majority of Beta's funds in a no load, low expense index funds. Okay, you know what is no load means what? There is no entry or exit load. Okay, if you buy some mutual funds, what happens is there are going to be some loads which will be there. So earlier there was some entry load, and SEBI has removed, at least in the Indian context. Exit load means if you exit any fund, any open-ended fund within 1 year's time, what happens is you'll have to pay some charges for the fund, and that is actually called as an exit load. It is. So in case of index funds, what happens is your expenses will be low and your loads will be almost null. That is the reason she has actually gone with the index fund. And at the same time, you can actually have exposure to equity instruments. You know, one secret. The secret is index is an all-time winning horse. Why?
There's a list of many different companies. So it is driven by the overall performance of the industry, not the company.
Okay.
But can you repeat your statement?
What I said is index is an all-time winning horse.
That is because it keeps on churning the companies inside it, and only the top companies are there inside that index.
So normally what happens is in case of index, you rarely the index construction and management company, they'll be altering their portfolio. Once in 3 years, what they do is once in 2 years, if they feel that any company is not really performing well, they will actually take out that company and they'll introduce one more company into the index. That is how it normally happens. Okay, we know that in the past we had Reliance Communication. It has been moved out now, and we had something called as Reliance Capital that is also moved out. Okay, so the companies which are not really performing well, what they do is they'll take out, and the companies which are performing well, they will actually introduce into the index. And because of which, what happens is which makes an that particular index is going to be moving up all the time. Okay, and you are there in the safe hands. In other words, if you feel that Indian economy is robust and things like that, you can think of investing in any index, because at least you'll get 12.5% or 12% CAGR return every year. You can compute the returns of the Sensex or Nifty. It has given you 11.5 to anywhere between 12% CAGR return for the last since from the inception. Okay, so that is the reason I said, if you don't want to take risk in the stock market, but you like some amount of risk, okay, so index funds are actually best bet for you, because index, unlike something, supposing if I tell you to buy Asian Paints, Paint is trading at 28.50 right now, okay, and I tell you that go buy it. So you buy 1000 shares of Asian Paint at 2850. Let's say, for example, after 6 months, it comes down to 2000 rupees. Again, you call me and ask me, sir, what shall I do? So I bought Asian Paints, you said, and it is down. Then I'll say, go buy another 1000 shares. You go buy 1000 shares at 2000. Okay. So same story after again 1 year or so, again you call me and you say that, sir, it is trading at 1000 rupees. What shall I do? So now I'll be confused what to say, because I don't have sort of confidence that you go out and again buy it. So that is actually going to happen with respect to individual stocks. But if we have bought, and let's say, for example, index ETF, what happens is, whether this maybe it is traded at 200 rupees, you bought 1000 shares, 1000 units, whatever it is. Again, it is came down to, let's say, 150. Again, I'll ask you to buy another 2000. If it comes down to 100, again, I'll say buy 5000 now. If it comes down to 50, again, I said go buy 10,000. Because I know one day it is going to go up. So the same assurance I cannot really give with respect to stocks. With respect to stock, the dynamic changes, because you know that there is something called as unsystematic risk which comes into play. I'll explain what is unsystematic risk in this particular case, because I'll be in fact exposing you what is systematic and unsystematic risk in this through this particular case, because there are company specific risks will be there. These are actually called as what unsystematic risk. Okay, you can actually eliminate this particular unsystematic risk by not holding those shares in your portfolio of investments. Okay, so that is one way of actually looking at the risk as a whole. Okay, so she would keep majority of Beta's funds in no load, no expense index funds. Okay, adjusting the level of the market exposure between 50% and 99%. Okay, so Beta's fund is an attempt to time the market. That is what Beta manufacturing management company would like to do. Anybody would like to ask me something?
Sir, I am not able to understand what is index.
Okay.
What
Index,
you explained about stock and index difference, that I understood, but actually if someone asks me what is index, then I won't be able to explain that way.
okay. I think I presume that you guys know what is index. Sorry for that. Okay, so now listen me out. What is this index is all about? If I ask you what is the temperature of India, what is your answer?
In one way, I cannot means average of maybe multiple places or
Range,
like
range you can say.
range. Okay.
Range.
Actually, the question itself is a wrong one. What I am asking is right.
So
The
average of
temperature is normally measured for one particular place. India has got so many states and so many what is it, the state headquarters. We can't really say what is the temperature of India. Still, if I pressurize you to do, so what you do is you tend to take up all these state headquarters, what is the temperature, and you come out with an average and you say that, sir, it is 40 or maybe 38 degrees Celsius. Maybe this is how you'll be saying, is it not? Similarly, if I ask you, how are the markets today? How do you answer this question? Because there are 5,000 plus companies which are listed. How do you say that the markets are up or down today?
Again, taking the average.
Okay,
Based
so
on
it is
Sensex
difficult to
and
track all the 5,000 plus companies. Yes, Deepesh, go ahead.
so
based
the
on Sensex and
Sensex
Nifty,
index
sir.
we are looking after. And so basically, I think top 100 companies it is taking average of
Okay.
50.
Nifty and
Okay.
Sensex.
Yeah. So what we do is, let's say, for example, I'll construct an index now. For that particular reason, what I did is I construct an index. So what I did is the companies which have got so much of strength in those companies, what I did is I just took all those companies into my as a portfolio. Okay, what I do is I'll take some stocks from the pharmaceutical sector. That is why we have got Sun Pharma, Dr. Reddy. I'll take some stocks from banking industry. That is why we have got ICICI Bank, HDFC Bank. I take into consideration of some power companies, NTPC, ONGC, which are there as part of that, which are actually representative of power sector. I'll take some infrastructure companies, and that's the reason we have got L&T and DLF, and so on. So I'll mix and match. I'll take majority of the sectors, and I'll take representative of the companies which are actually going to be representative of those sectors. I'll take into consideration, and then I'll form an index. I'll track only such 30 companies or 50 companies. And I say that if on an average, all those 50 companies are up, then I say that the markets are up today. If index is down today, then I say that the markets are down today.
So index can vary with each individual. Your index might be different than mine.
So since we are actually having an opportunity to construct our own indexes, how do you say that to have a general consensus, what we did is everybody else track the same index for easiness. So that is the reason National Stock Exchange has got its own index called as Nifty. Nifty 50 is what is Nifty 50 stands for is NSE 50 in short called as Nifty it is. What is Nifty index? There are 50 companies which is going to represent almost all the sectors of the economy, and that's how the index has actually got formed. Is it clear what is index now?
Yes, sir. And other is BSE, Bombay Stock Exchange.
Bombay Stock Exchange.
They have separate companies
They have
or
got separate index which is called as Sensex.
no, I got it. No, I got it.
Sensitive index in short called as Sensex. And Sensex has 30 companies as its portfolio of companies, and Nifty has got 50 companies. That is the difference there. That is
How many you said about the other one?
30 Sensex is 30 companies.
Okay.
Nifty is 50 companies.
Okay.
Clear? Okay. So because of this reason, what happens? Some days Sensex will be up. Some days on the same days Nifty will be down. Because the number of companies which are there as portfolio of as an index constituent stocks are different for both Sensex and Nifty. Because 20 stocks more for Nifty, and 30 stocks actually going to be for Sensex. Hope you have understood the basic understanding of Nifty and Sensex now.
Yes, sir.
Okay. So now you tell me why we have to invest in index, Preeti madam. I actually told you the answer as well.
No, why we have to?
Invest in any index.
Because, sir, what I got from your explanation is they are the selected lots of the safe stocks, basically, whom we can trust upon because they have been explored and top ones have been selected from all across the industries, not one. So if
And at
one
the
will
same
go
time,
down,
I also told that it is going to be an all-time winning horse. Why is that it is all-time winning horse?
why is it?
All-time winning horse.
Okay. So, sir, my answer would be the same kind of because across industry and safe bets kind of.
Because government by and large don't want to make it happen that India is actually going to go into a recession or something of that sort. Okay, so supposing any company is not performing well, we are not going to sit with the same companies. We will check and see whether the companies are really coping up with themselves in the next 1 year or not, 2 years or not. If the company is not performing well, what we do is we tend to remove that particular company from the Sensex or Nifty, and we will introduce some other company which has got some robustness in its performance.
So that Bombay Stock Exchange means Nifty or Sensex will do.
Yeah, the Sensex and Nifty construction and management companies are different. It has been outsourced, and
Okay.
they'll do it for the index.
Okay.
Clear?
Yes, sir.
Okay. Okay. So she had toyed with using a few different index funds at first, but soon settled on exclusive use of Vanguard Index 500 Trust due to its extremely low expense ratio and its success at closely matching the returns of the S&P 500 index. You can see S&P 500 is an index like same like Nifty it is. So they want to track this particular index. And what is that ETF or any index fund for that is Vanguard Index 500 Trust is the name of the mutual fund. Okay, they actually went upon means Miss Wolf. What she did is she went upon and went this particular what is it the mutual fund because it is closely tracking the returns of Vanguard Index 500 is closely tracking with respect to S&P 500 index. Okay, so that is the reason she went up with this, and also it has got low expense ratio. Low expense ratio means normally the expense ratio will be somewhere around somewhere between 0.5 to 2.5%. Okay, higher the expense ratio, it is disadvantageous for the investors like you and me. Okay, so lesser expense ratio is actually going to be much better. Why lesser expense ratio is better? Because returns will be more in that particular that is the reason we given a chance we would like to go for such kinds of mutual funds where the expense ratio is less. At the same time, the returns are in line with the index almost. Okay, so but she had lost some potential new clients who had actually thought it unsafe, and that the beta management used only index mutual fund and picked none of its own stocks. And there was a common consensus among the clients of beta management company that they're actually only investing in index funds, and they're actually not investing in other stocks. So that is the reason many of them actually dissatisfied. What happens if you only invest in index fund? The returns of yours will be exactly in line with what the index returns will be. But clients want some extraordinary returns. If you want to give extraordinary returns for your clients, what is that you have to be doing is you should take slightly some risk. You have to take some risk and invest in some other stocks, maybe some small cap companies or maybe mid cap companies and so on. So what happens in case of S&P 500 companies? Normally they invest in robust companies and well-known companies, in other words, and because of which yeah, your returns will be in alignment with the index return. That is the reason. Okay, so
Sir,
next,
this
yeah,
expense ratio and exit load are different things.
they are different.
Okay, generally 0.5 to 1% expense ratio.
Expense ratio lesser the better it is. At least in Indian context, 0.5 to 2.5% is regarded as an that is somewhere between that you will be having the expense ratio. If it is an index fund, so normally lesser than 1% should be your expense ratio. If it is a non-index fund, then more than 1% can be is desirable, because in case of index, you'll not be doing much of the juggling of the portfolio of investments. But in case of let's say, for example, yours is an infrastructure company, is a mutual fund, then you only invest in infrastructure companies. You may not be investing in the index companies also. In which case, what happens is the risk will be higher, and because of which, what happens, buying and selling is going to be slightly on a higher side, and because of which, what happens, the expense ratio will also going to be increased. The more you churn your portfolio of investments, what happens there is you tend to have more expense ratio, because you'll be incurring every time you buy and sell. What happens, you have to pay brokerage and all other factors which are actually will be there, no transaction costs. Those are actually called as transaction costs. The transaction cost will be
Is
more.
it charged at the time of withdrawal?
No, I'm saying, supposing if I'm a mutual fund manager, if I'm managing your fund, so
Okay.
if I'm frequently adjusting the portfolio of stocks, so I have to pay the brokerage charges. It is not free, right? Transaction cost will be there, and because of which, what happens, the expense ratio will go up. Hope you're understanding what I'm saying.
Okay.
Yeah, and that's why companies like Zerodha earn
Yeah,
lots and lots of money due to transaction on this future options on everyday trading. A
yeah,
lot of transaction happens, and these companies earn out of it.
yeah. So hope you have understood what is now the transaction cost and how it has been tied up with the expense ratio. So let us know move forward. Shoot.
I have a question. So, what is the threshold of small cap, mid cap, and large cap companies? Is there any threshold capital limit?
There is a threshold, but since it's very basic, I did not do sort of research as such. But means I don't have right now the answer in front of me.
Okay, okay,
What is the
sir.
market cap and all that? But I can answer your question by showing the live market as such. Okay, so I'll take an example of, let's say, TCS, which is actually a very large cap company. Large cap company means you can see 13,90,576 crores. This is the market capitalization of TCS. Okay, so let us take one more example. Give me some small cap like Birla Soft. Okay, so you can see Birla Soft in 17,509 crores only. It is. Where is 13 lakhs and where is 17,000? That is lakh crores. This is only 1,000 crores. It is 17,000 crores. It is. So this is actually going to be a sort of a small cap company. It is. Is it clear? Let us
Yes,
take Berger Paints. So Berger Paints, you can see market cap is 61,000 crores. We can call it as a mid cap company, not a small cap company. Okay, so right now I don't have a definition right now which is available with me. You can just Google it, you'll get to have an information. Only thing is they vary in the market capitalization.
yes, sir.
Okay, so the top 100 companies are actually called as blue chip companies, and we normally call them as the large cap companies. Okay, so large cap companies, the market capitalization runs into lakhs crore rupees. Okay, that is the reason it is actually going to be called as
Small
large
cap
cap.
company, it's 5,000 crores, sir. Below 5,000 crores market capitalization, it's small cap.
Small cap company, right? Okay, can you tell me some of the small cap company? How will I do it now? Is I'll go to screens now, create new screen. Okay, market capitalization below 5,000. I put it. I run this query. So you can see I have got many companies like as such. Okay, so I just click on one company. Okay, Triveni Glass. You can see the market capitalization is 29.7 crores only. If you have got 29 crores, you can very well buy whole of the company, 100% of the company stake you can buy. Is it not? Okay, so these are actually called as not even small cap companies. These are actually called as micro cap companies, which are lesser than small cap. Okay, so I'll go back and check some other company. Randomly, I'm checking. I have not even heard of this company's name as well. Okay, 46 crores. Okay, Yari Digital, it is 119 crores. You can see these are actually going to be companies as such. I told you. So, and you said what is large cap companies? Large cap companies is somewhere more than 80,000 crores. I have to check the definition since I don't know. I'm just putting 80,000 crores and above.
Sir, actually, this definition gets changed according to the mutual fund follow different definition. It follow different definition. For
So
example,
by and large, this is how it is actually categorized. You can see Britannia Industries is a large cap company. You can see. Okay, so you can actually go out and see what is the definition of it. But hope you have got the feel of what is small company and the large company. Is it? Okay, so then let us go back. Any other doubts, class, before we move on? Okay, she would focus on smaller stocks since she did not want to compete with larger unlist staffed funds on their own turf, and also because she already had exposure to S&P. She don't want to go for large cap funds because she has got exposure to S&P 500, right? So because she has got bought a Vanguard index fund as such, and it takes care of her large cap requirements. So that is the reason she don't want to go for the S&P 500 constant stocks as well as larger companies as well. Okay, so that is the reason she actually found out California REIT, and the second one is Brown Group Incorporation. These are the two companies she found out. Okay, you can go through what is the why she felt like going to these two companies. Okay, and next is she was quite worried about the variability in the individual stocks in general. Variability in the sense variability of the returns means what? What do you understand by variability of the returns?
The fluctuations.
Okay, if the fluctuation is more, if the stock is more volatile, what happens? The risk will be higher, is it not?
Right.
So that is the reason she is actually worried about the variability of these individual stocks. Okay, she noticed that these stocks. Yeah, anybody would like to say something? Okay, she noticed that these stocks both seem to bounce around in a price much more than the market, and she wondered if she was doing the right thing, exposing her clients to these new stocks. So what she has noticed is that these stocks both seem to bounce around in price much more than the market. Market means what here? S&P 500, which means these companies' variability is much higher than the variability of the index. That is what she noticed, and that is the cause of worry for her, because she has got higher, because she knows, in other words, she is investing in high risk instruments. Okay, what if they're not going to be giving the returns as per the risk they're actually giving? Okay, so that is what is her concern. Let us go through it. Okay, and there are some questions which are actually I posed, which I already posted. Let me go to the questions. Okay, for this, hope this Word document is visible to everybody. Hope everybody must have downloaded this. Let us go to the first question. Compute the standard deviation of the stock Californian REIT and Brown Group during the past 2 years. How variable are they when compared to Vanguard Index 500? Which stock appear to be riskiest? So what we have to do is, the first task is we have to compute the standard deviation of two companies, that is Brown Group as well as Californian REIT for the last 2 years. Okay, and next is we have to compare the risk of this with the index, and we have to say when compared to index which is actually more risky. Higher the standard deviation, higher the risk, in other words. Okay, then we have with us the Excel sheet also. Hope you have got Excel sheet with you. How many of you got your Excel sheet ready, which has been downloaded by you now? Good. So you can open this Excel sheet.
Yes.
If you are not downloaded, please do it, because we are running short of time already. I thought I'll be able to do this just in 15 minutes only. But the way you are actually asking questions, that is really like, I'm happy the way you're asking questions, because I never expected you will ask these questions actually, because normally our students will not ask because they know they'll be knowing it beforehand, or they must be doing some research before they come.
Sir, I was absent in initial few minutes of the class. Where is this Excel?
Okay,
It's an LMS.
this is an
It's
LMS.
also
You can
sales.
see risk and return case, it is there here, right?
Okay,
Session
okay,
6.
okay.
You can just open, and there is something called as C6.1. This is the Excel sheet. You should keep it ready.
Already shared over the group.
And I have opened just now this table one, this particular tab.
Yes, sir.
Okay, so you can see 1990, 1989 and 1990, 2 years returns are actually given you. Okay, so
Yes.
what this particular table tells us, this is a monthly return. So we have discussed in the last class how to actually download the data. So here
Yes.
here the differences they have given us calculated readily, and even the returns are also computed for us. We need not to compute this. We know now how to compute these returns. We have discussed this in the last class. Raw return, how
Yes.
to compute the holding period return. You know now how to compute this. Okay, so you can randomly select two stocks and even the index as well, and you can download the the price points for the last 2 years, and you can still do. But I am going with this, sticking with this case because I have to discuss case. There is a reason I am actually sticking to this particular Excel sheet, and you can do later on the way you feel like doing it. Okay, so this is Brown's data it is, REIT data it is, and the index data it is. I call it as index data because this is the replica of the index, because it is as good as Vanguard index is actually going to be what? It is the replica of S&P 500. And this is for the REIT stock. It is she wants to invest in, Wolfie wants to invest in REIT as well as Brown Group. So let us compute the standard deviation just in one step. So how to compute standard deviation? STD. S stands for what? It is the sample standard deviation. It is. And okay, one more is there. It is. And let me show you. It is STDEV dot P. It is P for population. It is. Normally in finance we only deal with the some particular amount of data. That is the reason we call it as we have to always pick up this sample standard deviation with this, which is having dot S. Okay, so how to do it now? So I go click on this and I select whole of the range. I click enter. So then I must have computed the standard deviation of index. So will you do along with me now?
Yes, sir.
It is very easy. Okay, whole of this case is very basic case. It is. Need not to be worried as such. It is easy one. So this is, I call it as index. Okay, I'll write it as standard deviation. Sorry, they call it as standard deviation. Index we have computed. Let us do for REIT now. REIT is real estate investment trust. She want to invest in Californian REIT, in other words. That's it. Okay. So if you want to have an exposure of real estate market, so if your ticket size is less than, let's say if it is 2 lakh rupees or so, you tend to go out and invest in REITs. Clear it is? Normally, in India, the real estate game is considered as a big daddy's game. It is because you require lots of money to invest in real estate, right? If you want to buy a plot of 30, 40 square feet, 30 by 40, you know that how much money it is required, right? Normally, in some of the good areas, you might require more than 1 crore rupees as well. Is it clear? Supposing if you want to have exposure to real estate, what you tend to do is you go and buy REITs because the ticket size is 2 lakh rupees. Okay, so what I do is it is something like investing in a mutual fund. Okay, so instead of they investing in stocks, whatever the money which has been pooled up, they tend to invest in real estate properties, and whatever the rental yield they'll be taking it up, or capital appreciation if something happens, that will be passed on to the investors in a later stage. That is the reason it is actually called as investing indirectly into the real estate. That is actually called as REIT, real estate investment trust in short. Fine. So shall we do it? STD. So I click on this. So I got answer for REIT as well. Then let me go for Brown group. So Brown group is also same, right? So this is. So I'll convert this into percentage terms. It was a decimal earlier. Hope your answers are matching with mine.
Yes, sir. But sir, just for the information point of view, why we are calculating the standard deviation?
Standard deviation. So you can just go through this. Compute the standard deviation of the stock REIT Brown group during the past 2 years. Okay, so what is the standard deviation tells us is this tells us the variability of the returns. In other words, higher the standard deviation, higher the risk it is. Okay, it is going to measure the risk. We are actually discussing risk and return, right? As you know, what we are discussing, we are discussing the risk and return chapter, right? So since we have understood what is return, how to compute in the last class, so we are now exposing ourselves to how to compute risk. Is it clear? The standard deviation is the measure of risk. Tell me now, higher the standard deviation is good or lower the standard deviation is good?
Lower standard deviation will be less risky.
Okay, so it goes with how risky you are as a person. Okay, so supposing if you want more risk, if you love more risk, and if you are a risk taker, obviously you tend to go for an choosing that stock which has got higher standard deviation. Okay, it is a most individualistic question. It is. So what is good for Chetan may not be good for Nirankar. Maybe not may not be good for Naresh for that matter. Is it clear? It's going to be individualistic. It is. So can you tell me now which is most riskiest among this?
REIT.
So among REIT and Brown, because we are only discussing these two stocks to start with, because this is an index. We should not be comparing index to start with. Let us now only discuss among REIT and Brown. You know that REIT standard deviation is higher, so we tend to say that REIT is risk is more when compared to Brown's risk, right? And if you compare the index standard deviation, you can see index is how safe it is, because the standard deviation of the index is only 4.6%. Okay, and RE8 is what is it? RE8 is risk is actually 9.23. It is more than doubled, in other words. Okay, so now you have understood now that how to actually measure the risk component of it. Is it clear, everybody, how to measure the risk and what is standard deviation is all about? Let us see now.
Yes.
Which stock appears to be riskiest? So we have got the answer now. So the RE80, is it not? RE80 is going to be 9.23, which is higher than 8.16%. That is the reason we said that RE80 stock has got higher the return, higher the risk, right? Let us go to the second question now. Okay, so I hope the second question is visible to everybody.
Yes, sir.
Okay, suppose beta company's position had been 99% of the equity funds invested in the index fund and 1% in the individual stock. Okay, so what is that they are saying is 99% of your funds will be invested in the equity index, and only 1% will be invested in the individual stock like REIT and Brown Group. Okay, so in that case, calculate the standard deviation of this portfolio, because the moment you got more than one security in the portfolio, okay, then it is actually called as what portfolio it is. What is portfolio of what is a portfolio? Portfolio means it's a mix of various asset classes. Okay, what is portfolio? It does not mean that all the time portfolio means it should be comprising of only equity shares only. It can be a mix of real estate, bonds, mutual funds, stocks, indexes, anything for that matter. It should be an appreciating asset. If you have all those in your portfolio, then that is actually called as what? Most diverse portfolio. Why we actually construct a portfolio? We construct a portfolio to derive diversification. You know that you should not put all the eggs in a single basket, right? Supposing that you have invested everything else in a single company called as Tata Motors. Tomorrow's recession happens, many of the people lose their jobs, and because of which what happens? People don't buy, they don't go out and buy the cars of Tata Motors, because they are fearful. What if I'll be sacked tomorrow? Okay, so what happens in these are actually called as cyclical stocks. What are the cyclical stocks? Because if economy goes into downtrend, what happens is chances that these particular stocks are actually going to be crashing like anything. Getting it? So what you have to have is you should have a mix of companies in your portfolio of investments. Supposing if you have, on the other hand, let's say HUL as a company, Hindustan Unilever. Okay, more or less what happens, the returns of this particular company will be same, because nobody will give up brushing their teeth or something of that sort. Okay, if there is a recession tomorrow, is it not? Because of which the products of FMCG companies more or less will be saleable in the market at the same level, and at the same time, what happens is the profitability of those companies will also be more or less will be same. Sales will also be almost more or less they're actually going to be same, and because of which what happens, the stock price correction will be less when compared to other types of companies. That is what you have to be keeping in mind. So if you create a portfolio with mix of stocks, then what happens is you are actually assuming that what is going to be happening there is diversification is actually going to be happening. So that is the reason we have seen that there is a sort of a negative correlation between the gold price fluctuation and the stock market. People say that if the stock market is going down, what they do is they sell their portfolio and they actually switch on to gold portfolio, which means they buy gold, in other words. So what happens? The gold prices tend to going to be, because people feel that the gold is actually going to be most sort of a safe haven for them, and that is the reason what they do is they sell these assets, means the portfolio of equity, and they start buying the what is it, gold, physical gold, or maybe paper gold, whatever the case may be.
Sir, but
Yeah.
in last 20 years or 30 years, market has also increased and gold has also increased. So
Yeah.
we can say that in long run, there is no as such a negative relation. The negative relation can be in short run only.
Correct. I'm only speaking about the short term only, because it's a temporary feel that let me actually sell my some of my stocks which are riskier, cyclical stocks. I park those funds in the, let's say, gold as such. Okay, so in the long run, everything else goes, and you know that investing in gold, you'll not be able to become richer. Okay, because it can only beat the inflation. If you want to become richer, you have to start your own business, or you have to own a piece of land, or you should invest in stock market, which means you are indirectly investing in business. Okay, because if you invest in gold, you can only beat the inflation. So you'll never become richer investing in gold, in other words. Okay, so suppose that beta company position had been 99% invested in the equity funds, invested in the index fund, and 1% in the individual stock. Calculate the standard deviation of the portfolio using each stock's beta. So we have to compute the standard deviation of the portfolio now. Okay, thinking that 99% you invest in what is it, the index fund, and 1% in let's say company like REIT. In next instance, we'll be investing 99% in index fund and 1% in the brown group. So that is what is we are actually going to be doing now, and we have to compute the the portfolio standard deviation. So how does now each stock affect the? Let us now actually do this part and come back and see what is there in the next part. Fine. So what I do now is I'll go here. So standard deviation I'll compute now. So this time what I do is I'll take up index. Okay, and I'll also go with the REIT. Okay, so in the next case, what I do is I'll take index and I take brown group. Okay, so this is my portfolio 1. This is my portfolio 1. This is my portfolio 2. It is. There are 2 portfolios I'm constructing. So tell me then what is the I have to compute now. What I have to compute the portfolio standard deviation. Okay, so I'll take my individual standard deviations into consideration for my reference, which I know it already, which I have computed. So now I'll write the weight now. And this is the standard deviations. So what is the weight they have told in the problem is 99% we are investing in index, 1% in the individual stock. Okay, in the portfolio 2 also it is the same. Okay, so can we now compute the portfolio standard deviation?
Can you go back and show the weight part once again?
Pardon?
The weight part, the 99.
No, you should have your this.
Okay, got it. Got it.
Just a minute. Yeah, you can see the portfolio standard deviation equation I have written here. So W1 is weight 1. Okay, so this is your weight 1 and this is your weight 2. Okay, so weight 1 square multiplied by standard deviation 1 square. This is your standard deviation 1. Okay, this is standard deviation 1 and standard deviation 2 it is. Okay. And you have to multiply, you have to square, and then you have to multiply, and then you have to add. Then 2, you can see plus weight 2 square. What is weight 2 square for me? It is. So this is my weight 2. It is square it. Okay, multiplied by standard deviation 2 square. That is 9.23 square. Okay, then is plus 2 multiplied by W1, W2. You have to multiply these two multiplied by covariance between 1 and 2. So now we have to compute the covariance now, because we have known computed the standard deviation. We know we have weight was given to us. Only thing is we have to compute the covariance. So let me compute covariance now. I'll tell you what is covariance as well. Give me some time. So now I computed covariance is equal to covariance. P and S both are available. So click on covariance yes. Okay. So for this index and REIT we should be computing, right? So between index, comma, REIT, click enter. You got this covariance. So understood how to compute the covariance. I'll tell you what is covariance. So how many of you computed this covariance now? So similarly, let us compute the covariance for the second set. Okay, so that is equal to covariance between index and brown. That is index and brown. Click enter. So we have computed the covariance between the index and the security. Okay, so if you have computed the covariance, just put in the chat box yes. If you are ready until this, if you are done until this. Okay. So Karthik,
Done, sir.
Soham, Asif. Okay. So done, right?
Sir,
Okay.
what is literal meaning of this covariance?
Pardon?
Meaning of covariance.
Yeah, I'm going to explain that. Okay. So covariance means if one particular security is moving up, okay, how much whether the second security is also going to in tandem with the second security or not, that is actually going to be telling you. Okay, by looking at this, we are actually going to say that both are. Let us actually concentrate on this number. Okay, sorry. Okay, you can see 0.0031. So what is that we should be knowing here is it is a positive number. It is. So positive covariance means if the stock price, if index is going up, REAT is also going to go up. Okay, and if it has got a negative covariance means if index is going up, REAT is actually going to go down. Something like that. It is.
The higher the covariance, higher the positive relation.
Correct. It's sort of an correlation. It is. Okay, through covariance where we can actually compute the correlation coefficient also. But covariance is actually going to be telling us, okay, a sort of relationship with the other stock in the portfolio. Okay, so while actually including two securities in the portfolio, we should actually see what is the covariance. If the covariance is positive, we can say that they're actually moving in tandem with each other. If it is a positive covariance, it is. If it is negative, one stock will be going up and the other stock is actually going to be going down, and so on. That is what it is actually going to be. Is it clear, everybody? That is actually called as covariance. It is. So let us compute now the portfolio standard deviation. Okay, so portfolio standard deviation of portfolio 1 will do first. So portfolio 1, let us compute the portfolio standard deviation. Okay, so what I
Sir,
do,
what is the significance of the amplitude of this covariance? Positive and negative, we understood.
positive and negative we can understand, but if you want to understand what is the strength of relationship, then you should actually compute the correlation coefficient. Okay, so correlation coefficient, if you compute, then you'll understand. Okay, let's see correlation coefficient. You can see here, right? So what I do is index and REAT. I'll go index and REAT. Okay, so correlation coefficient we have computed now. So now can you tell me now? You know that correlation coefficient in your statistics class, you must have learned correlation, right? So tell me what is 0.07 signifies as a correlation.
One unit of change
It's
in
the
index
74% variability in
7%.
one unit change in index can change the 7%
It
impact
is
on.
not percentage terms, right? Because you know that correlation varies from 0 to -1, right? -1 to +1, you know that. -1 to +1. Sorry, I should have written here 1. So the correlation varies from -1 to +1. Okay, so 0.07 means what? It is not 7%. Please try to understand. 0.007 is almost equal to 0, which means there is no correlation, which we are failed to say with respect to covariance, because it is only we were actually saying that there's a positive sort of correlation, but we were not knowing that how much positive it is. Now after computing the correlation, we will be able to say that what is the strength of that particular positivity. Okay, now say that almost it is zero, which means there is no correlation between index and REAT stock as such. There is no correlation as such, is it not? Which means if index goes up, we can't say that REAT is also going to go up or not. Correct? Okay, so that is actually called as this. And let us compute. I think this is also more or less will be same. Let me compute correlation.
So, sir, just one question.
Just a minute.
So,
Just a minute. Then what is the reason why we have computed covariance? Why have not computed correlation? Because in the equation you can see there is an covariance. That is the reason we are computing the covariance. If there is a correlation, you would have computed the correlation it is. And you can see 0.65 it is. Correlation is 0.65 between index and the brown. What you can see, there is a positive correlation, is it not? Because it is moving towards +1 and it is not towards 0. It is 0.65 is moving towards +1. Correct? Yeah, you had any question, right? You were asking some question. You can go ahead.
yeah, I was saying, like if covariance will vary, in that case we can make a relation, like means we can assume that in RET will index will move and it is low risky.
We can't really say by looking at only the correlation coefficient whether they're risky or not. But I can say that if you want to diversify your portfolio, you should have stocks in your portfolio which has got negative correlation or maybe zero correlation.
So basically,
If you
covariance.
want to diversify, I repeat what I said. Please understand what I'm trying to say. If you want to diversify your portfolio, you should include two such stocks which has got zero correlation or -1 correlation. Why is that I'm saying this?
Zero correlation means will not be affected by it.
Correct. So which means if you want to have a diversification, at the same time you want to invest two securities in the portfolio. If you want to keep two securities in the portfolio,
they are like gold in our portfolio.
Yeah, now you have understood why is that what is the importance of now correlation now. By looking at the correlation, okay, we can say that what is the strength of the relationship. If the relationship is very strong, we don't want to diversification will not be achieved, is it not? So we should go for such particular stocks where the correlation is 0 or -1. So at least if one security is going up, the other security is if the one security is going down, the other security is actually going to go up, and that's how we can actually safeguard your portfolio. Hopefully you're understanding the insights regarding correlation as well. Though, yeah. So any other doubts you have got? Nirankar, I think Nirankar sir, you must be having some doubts. Go ahead.
No, sir, doubt has been cleared. Means I was just looking for the significance of the variance. So as you told that if it is it will be the zero. So it will means both portfolio will be independent and we can be on the safer side. If it will be negative, there will be no correlation. Means there is no strength of correlation or relationship between two portfolio, and we can invest that will be safer side.
Yeah. So if you want to achieve diversification, then correlation, you should look at the correlation as well. Like whether it is 0, it is towards 0 or it is towards -1. If it is +1, we should not invest because if one security goes up, the other securities goes up. If the one security goes down, the other security will again go down. So if you want to diversify, that is not the good idea. Okay. Hope you have understood this.
The correlation is fine. And what is covariance that you told?
Covariance is an absolute number. By looking at the covariance, we can only say whether there is a positive relationship or a negative relationship. That's it. You can't go beyond this particular analysis with respect to covariance. If you want to have a sort of conclusion, then you should compute the correlation.
Okay.
Okay. Why we have computed covariance? Because in the formula, in the equation of standard deviation, we have covariance, not the standard deviation, not the correlation. That is the reason we directly went out and we computed the covariance. Since there is a huge number of questions which has come up, that is the reason to address your query, I computed correlation. For this particular, what is it? The case, we need not to compute the correlation. It is. only it's a added piece of information. Okay, if you want to diversify, then you have to look at the correlation coefficient of the stocks, which you'll be including in the portfolio of investments. Clear? Yeah.
Sir,
So let us,
can you also put the formulas for the portfolio one where you calculated the index? I presume my values are not matching
what is it you
for
said?
the
Come again?
for the index where you have calculated index and REIT. If you could just put the formulas once,
Of
because
what?
my
Every other formula is here only.
it's the same. I mean,
No, everything it has been every formula is here only, right?
no,
Standard deviation.
I just wanted you to add by putting a formulate. So just to have a look.
All formula I have put up here.
And like in row 5, row 6, and
Row
similarly
5.
row 9 or 10. Yeah.
This one.
So F5 and F6
F.
for these values. Yeah.
Okay.
Similarly for the F9 and F10 also.
F9. F9 is this. No, this is again, this come from here. It is, that's it. We have computed, we have just taken from here only.
Okay.
So,
okay. Directly.
And 99% and 1%, it is given in the problem case.
Okay, sir. Okay.
4.606 we have computed here, right?
Okay, got it.
9.3 we have computed 9.23.
So I thought we are taking it for some specific values only. So
No, just a
just
minute.
wanted
If
to
it is
confirm.
confusing, then I can put like this. Is it fine?
Yeah, yes, sir. Now understood.
So similarly, we can do for this also. These are the references from where it is coming. Okay. Is it clear now?
Yes, sir.
Okay. So now we have to compute the portfolio standard deviation. Can you compute, because you have got the equation in front of you? Okay. So we have to go out and do
Is
this.
0.002087.
The W1 is which one? W1 and W2.
I'll show you. You can just go through it. W1. So W1 is what it is. It is actually called as your weight one. It is weight one with respect to portfolio one is what? This one is your W1. It is. Okay. So what I do is I'll do is equal to W1 square, right? Multiplied by
Yes, sir.
W2 is this one. Do it along with me. I'll go slow so that you'll not be missing out. W1, W2 is fine.
Sir, but in the formula, it's written W for the part 2.
Standard deviation. Standard deviation one, sorry. We have to multiply this actually, not W2.
W1 square into standard deviation, then W2 square into standard deviation for 2.
There is square of standard deviation also. Yes.
Is it fine?
Yes.
So next is what? W2 it is, right? W2 is this one.
Yes.
Square multiplied by
Standard deviation square.
2 square, right? Until this, if it is clear.
Yes.
Do it
Plus
with me. Plus 2.
2 multiplied by W1
is this multiplied by
W2
is this multiplied by covariance.
Covariance
So covariance is this one. This is applicable for the portfolio one. Is this?
Yes. Covariance.
Covariance. For covariance between 1 and 2 is 1 is index RE8 is 2, right? In this case, covariance between 1 and 2 is this. Is it clear? Shall I press enter? So I am getting the standard deviation of the portfolio now.
So yeah.
So please put the formula text here.
Okay. So can you compute a portfolio 2 standard deviation? Like this. How many of you getting 0.21%? Just put S in the chat box. Let's see. Okay, you put already. Fine. Great. So what we do is now we'll go compute the portfolio 2 standard deviation.
हेलो
Okay.
मैं कॉल करूंगा तुझे क्लास में
So same it is again is equal to, those who have missed it, you can just go through it now. So it is W1, this is W1 square, it is W1 square multiplied by standard deviation 1 square, right? Next is W2 square multiplied by
up
this.
to 2 digit it is same in both if you calculate it.
First one, my answer is like 2087, means 20.87.
Oh, is it? So weight multiplied by covariance, this one. Just see, is your answer and my answers are tallying?
Yes, sir.
So like for portfolio 1, if suppose my answer is 0.0020, so these approximations are fine, or do we have to calculate just the exact?
Actually, you should get the same answer, right? Because everybody are using the Excel only. You are not doing manual calculation.
I don't know, some I think errors are there in terms of decimals.
You
I
tell
think.
me whether your answer and my answers are exactly matching. Just put it in the chat box. Let's see.
Yes, sir. Exactly. Match.
You should exactly
Yes,
match,
sir.
right? Because it's Excel sheet. That is the reason we are using Excel. If you are using some calculation, then I can say that you are doing some round figure calculation. That is the reason it is different or something of that sort. It is. So it has to be same actually.
I presume somewhere I
You
have
must have
taken.
committed some error. Just you can go through and check. That is the reason I normally check up with answers what I computed with my fellow students or participants answers, because I may also do some mistake while doing it. Because in the first instance, when I was doing instead of SD1, I was doing W2 there. Is it? Just go through it. I think you should get the same answer as mine.
Same answer, got it.
Okay.
So now what does it mean, sir?
Yeah. So we will come to that. What is the meaning of this? So can you tell me now which is actually going to be more riskier? Which portfolio is more riskier?
Second one.
You know that though there are actually going to be slightly differences, it is not that great difference it is, but still we should actually consider the one which is actually having more risk. Okay, more risk is what? You can see the brown is actually more riskier, but you can see the REAT is having 9.231% as a standard deviation. Okay, when you diversify, you can see the resultant, the risk is actually reduced. That is the magic. Are you understanding what I'm trying to say?
Please say again.
This is due to covariance, I think.
Yeah. So because of the covariance and all other factors, what is happening there is, when you diversify, what happens is the portfolio risk is reduced. So now you tell me, forget about portfolio, these two what we have computed. Only just go and see what is the standard deviation of these two. That is this. Just a minute. You can see the standard deviation is 9.231. And the standard deviation of brown is 8.167. Which is more riskier? REAT is actually more risky. That is what we said. Okay. Now REAT and index when we mixed, what is the portfolio? What is the portfolio standard deviation we achieved? The first one it is 0.2087%.
Yes. Yes.
Okay. This is actually lesser than this one.
Yes.
Which means what I'm trying to say here is, what is it I'm going to convey here is, just because the standard deviation is higher. Okay, so we cannot really say that once you combine in the portfolio of investment, your standard deviation of portfolio standard deviation is also going to be on a higher side. It is wrong to presume so. That is what I'm saying. Assume so. Okay, so you have to actually combine, and because of which what happens is, because of the diversification effect, what happens, the portfolio standard deviation is actually going down there. Okay, supposing if I would have not taught you how to compute the standard deviation of the portfolio. If I would have asked you, supposing if you construct two portfolio like this, which standard deviation of the portfolio will be higher means naturally you would have told that the REIT and the index portfolio, that is portfolio number 1, will be riskier. That is what you would have told, right? Since now we have quantified it, portfolio standard deviation, now we are understanding that it is not the case. Okay, so let us see what is there in the next question. Okay, so calculate, it is over. How does now each stock affect the variability of the equity investment, and which stock is riskiest now? It is. Now we are feeling that drone is riskiest. After the portfolio of investment, after the portfolio construction, we have understood that it is slightly riskier, right? Explain how this makes sense in view of your answer to the question number 1 above. So that also we have done it in our just now. What we have done is we have actually computed the standard deviation of both the stocks and the standard deviation of both the portfolio, and we have compared both of it, which means we have answered the second question. At us. Shall we move on to the next question, or you have got any doubts before that I move on?
So just one doubt means based on the calculation means you are saying that portfolio 2 is less risky in compared to portfolio 1.
Huh. No, portfolio 2 is more risky, right?
But its value is coming 0.2129%.
So 0.21 is higher than 0.208, no? 208, no?
Oh, okay.
See for yourself. That is the reason I have actually did it for 4 digits here.
Sir, in that case, what we call that index and two, we take in the two stocks kind of. So the more riskier one will be more good to combine with the index one. In that case, what we have calculated.
If you want more risk, then definitely you should go with the Brown and index. That is what the results are saying us. Okay. And you want less risk, then you should go with the REIT and the index. Is it fine? So let us now move on to the next question. If you don't have any doubts now. Okay. So perform the regression of each stock's monthly return on index return to compute the beta for each stock. Explain what is systematic and unsystematic risk. Okay. So let us now we have computed the standard deviation. This is one way of looking at the risk, measure of risk. There is something called as beta of the stock as well, which is actually normally considered as you must have seen many a times stocks beta of the stock. You must have heard many a times, but you may not be knowing how to compute this. Now we will be knowing it how to compute as well as how to interpret this. Is it fine? So please concentrate now. Beta of the stock, how to compute. Right. So please concentrate, class. So I am doing now the beta of the stock. Okay, so that is REIT beta I am computing. Okay, so I will be computing the REIT is beta now. So the function Excel function for the computation of beta is SLOP, slow function it is. Okay, is equal to slow, and your y and x you should actually you should be very careful what is y and what is x here. Okay, so what is x here and what is y? You know the regression, right? So x is independent variable and y is dependent variable. Correct? So now tell me what is x and what is y here? Okay, because now concentrate only on REIT and index. Now forget for a while that you got this. Okay, I hided that. So tell me among them what is dependent, what is independent. Tell me what is x and y.
Index should be independent, I guess.
Index is x.
Index is
and
dependent.
REIT is y, because y's returns are dependent on the index return. Is it clear? Any doubts are there? This is how we normally take into consideration.
Sir, please come again. Sir, please come again.
Yeah. So do you know what is x and y now? Independent and dependent.
Yes, sir.
Don't forget this. What is independent and what is dependent? What I'm saying is the REIT returns are dependent on the index return.
But I have a question, sir.
Huh.
I mean, the index return should also be having REIT inside its basket, right? So index is the summation of the returns of individual stocks.
Okay.
Yeah, I have the
Correct.
same doubt, sir.
So that normally what happens regression while we do it. Okay. So the standard statement is the returns of the independent stock is always dependent on the returns of the index it is. Okay, if you are not convinced with this, then you cannot really go out and do the regression analysis. You can't compute the beta as such. So you see that the returns of the Vanguard index, you can see sometimes index the constant. See, in case of REIT, it is not part of the index at all. It is not the constant of the index at all in this case, because it is a real estate investment trust. It is maybe in case of Brown, you can say it may be part of the index for that, or it may not be, because since it's a very small company, it may not be part of Vanguard 500 index as well. Okay, as going by the theory, normally what we say is the returns of the individual security is always, the returns are always dependent on the index. That is the reason it is independent. This is the independent variable and this is the dependent variable. Okay. So you can also go and read some literature. I'll also post it in the LMS later on. Maybe you will be convinced at that point in time. Maybe at this point in time, you may not be convinced what I'm saying. Okay, so let us do some reading and we come back and you'll be able to convince. Okay, is it fine? Shall we move on? Otherwise, we'll be wasting time discussing the same.
Right, sir.
Okay. So let us have literature. Let us read it and come back and debate if it is required. Okay. So now what I do is I'll go and compute RE80 now. RE80 is beta. So SLOP slope function y. Y is this returns of RE80 comma x is this, and then I close the bracket, enter. I got the value of the beta. Fine. So now I do the same for Brown now. Slope as we told, this is y and this is index. So we have computed the beta of the Brown. Okay. So next question is how to actually interpret this values, because anybody can actually compute this, or many times what happens is this beta value can just go and download from any of the internet website.
So Brown, you have taken the wrong value as a independent value, sir.
Is it?
No, it's
No, sir,
the
you're correct, sir.
significance is beta is
Just
No,
correct me
it's,
if I'm wrong.
it's correct. It's,
Okay, sorry.
Okay, if your answers are matching with my answers, just put it yes in the chat box.
yes, sir.
Otherwise I'll be confused. Okay.
yes.
Sir, please repeat again what is significance of beta.
No, I have not even told. Please concentrate. I am telling now actually.
Okay.
Okay. So by default, indexes beta is 1. Okay. Not percentage it is. Always it is 1 it is. Okay. So index beta is all the time it is 1 it is. That you have to be keeping in mind. Okay. So if my assume that my stocks individual beta, okay, 2. What is the meaning of this is? Okay. So if my index is going up by, if my index is going up by 1%, my stock will go up by 2%. If the index is going up by 1%, which means my stock will go up by 2%. Same applicable if the index is going down by 1%. So my stock will go down by 2%. So this is how we ought to interpret the beta. Is it clear? Now, now let us take, that index is 1. Assume that it is -1. How do you interpret this? And beta is -1. Go down by 1%.
Negative relation.
Understood, no? It's a negative relationship. That is
Cor-
what to count.
Correlation will be negative in this case.
Yeah. So that is what you have to be understanding. What is beta of the stock? Now,
Sir-
can you tell me what is beta phi of any stock? Correct. So supposing that what if my beta is 0? Okay. So if index goes up by 1%, I can't say that whether my stock will go up or go down. It is going to be directionless. I can't really judge that. Is it clear what is 0 beta is all about?
So in any case, index will be 1 only.
1 only, yes. By
Sir,
default, it is 1.
Say it again that if index will go up by 1, it is stock will go up by 2%. Is it assumption or
This is as per the concept of beta it is.
so? But where is 2 mentioned? This 1 and 2
No,
that
I am giving you an example here, various examples. Now let us now discuss for RE80. Can you tell me now beta of 0.4 is 1.14 is the beta, right? Can you now interpret RE80 beta now?
So if index goes up by 1%,
1%.
then it will be
Go
our
up by
REIT will go by
0.14%.
0.14%. Yes.
4%. You have now interpreted. Now can you tell me this one?
Index goes up by 1%,
Similar.
then down will go up by 1.16.
1.16%.
0.6%. Is it not? So that is how we have actually computed and we have understood how to actually interpret the betas as well. So now you tell me, if you want to diversify your portfolio, what kind of beta you should be having in your portfolio? Supposing you have got an index
As
and
you
you have got
said,
RE80 as well.
Like brown.
Brown is actually a positive correlation, right?
yes, it should be negative. I mean,
Negative
Negative.
correlation.
Beta should be negative. If the beta
Okay.
is negative, then we can say that we can actually achieve a sort of diversification in the portfolio. You know what is diversification, right? If I don't want to assume any diversification, if I want to have if going up should also go, other stocks should also go up, then I should go with the beta, maybe positive.
Sir, but in that case, if we have a negative correlation and
Huh.
index is a long-term winner, then my stock will be a long-term loser.
But-
That is the reason you should see the beta of the stock before.
But
actually.
risk will be loss.
Okay, so you should actually, this is the measure of risk it is. Beta is actually going to be measure of risk it is. Hope you're understanding what is beta as a concept. This is all about the beta concept as about, is all about. Okay, so any doubts you have got, you can ask me so far what we have discussed.
No, like you said, sir, stock has got 5 value and index beta has got 1. So if index goes up by 1%, so stock goes up by 5%, right?
Which means more riskier the stock it is.
Okay.
So I'll tell you now. So if the
So in case of
no,
it is
please
more
listen.
risky.
Please listen to me. If the stock's beta is 1, what is the meaning of that? If it is in tandem with the index, it moves up and moves down. You know it. Correct. So can you tell me now what are aggressive stocks?
It will be with a very
Aggressive
high beta.
stocks are those stocks whose beta is more than 1. Do you accept my point of view now? What are defensive stocks now? The defensive stocks are those stocks whose beta is lesser than 1.
Sir, so sorry to interrupt. Can
Yeah.
we continue in next class?
Yes, definitely. So I thought I'll be doing this particular exercise just in 15 minutes. And even the time is not sufficient for me to explain this one case. That's good. Lot many questions are coming up. Okay, what we do is we will close the session now and we'll continue after the break. Fine?
sir, just give 5 minutes to this one next class when you just log in this.
Yeah, we'll complete this and then we'll move on to the next one.
Okay, beta 1. Okay, thank you.